Well, Santa Montana once said, everybody makes mistakes and everybody has those days. And it turns out, well, quite a few economists made a mistake this year in forecasting a recession. Now 2023 broadly seen as a relatively good year for the economy as inflation fell rather quickly while maintaining a strong labor market. Here to explain where economists feel they got it wrong and also what it means for the year ahead, our very own Josh Schafer. Josh, what are you learning?
Yeah, Shauna, so I called a couple of these economists and sort of phrased it to them that way. What do you think happened in 2023? What were you expecting? And they all sort of highlighted similar things of headed into 23. Most economists saw the Fed's interest rate hiking cycle essentially slowing employment, eventually bringing the unemployment rate up, which would hurt consumers. We would spend less. We would go into a recession, right? That's the classic playbook. You can see that's part of what has happened in the past as well. But they pointed out a couple graphs that when we talk about economists, they have models, right? We put in certain numbers into models, and that's how we create forecasts. But when you have a pandemic, the models don't work that well. And in some cases, it's really not, I would argue, not really their fault. So if you take a look at excess savings, one of the main things that was wrong, this is a chart from Deutsche Bank, you can see here pre-revision, so revision came in August, and you can see pre-revision, we thought people had a lot less money than they actually had. You can see that purple line there is post-revision. So when you're forecasting things and you think Americans have a certain amount of money, and in reality they actually have more money than you thought, it might make sense when they spend more money than you thought they could because they literally had more money. Another part of essentially the resilient consumer that we saw in 2023 was what we saw with jobs data. When you take a look at non-farm payrolls, so this graph can be a little busy. I don't want you to get caught up in those little up and down, Shauna. See that big one?
There's a lot of up and down.
See that big one with the 14?
Yeah.
See how that's a lot bigger than we've seen in the past? 14 straight months that the jobs report beat consensus expectations. So that sort of speaks to how economists just couldn't really read the labor market in this moment. That was about triple the amount we had ever seen in a row to happen. So a big, big beat there. And then I want to go back to that Fed funds rate full screen that we were looking at to see how aggressively the Fed hiked here. You can see that 2023 hiking cycle, right? Really, really fast. Well, economists say when you think about how fast the hiking cycle was, a lot of us actually didn't get caught up in the rise of interest rates. So if you take a look at, say, mortgages, right? Mortgage is an easy way to understand how interest rates go up. What you're looking at there is the 30-year fixed mortgage. This is a chart from Bank of America. But the purple line is what people are actually paying. So as interest rates shot up, a lot of people had already gotten in at a low rate, right? You'd already gotten in at 2.5%. So you're not going to refinance to pay 7%. You're going to sit at 2.5%. Well, mortgages are 70% of household debt. So if you're not actually paying the high interest rate, you're not, again, you have more money than we thought you'd have. So it was a little bit of an unprecedented Fed hiking cycle, and really most economists pointing to that economic stimulus sort of throwing things off.
Yeah, and it's an unprecedented housing market too, and you take into account all of those factors and exactly the dynamics playing out. But Josh, I'm curious, do they give any sense in terms of whether or not some of these models are going to be more reliable next year, or is it still going to be a similar type story?
Right. So, I mean, we're talking about the forecasting industry, right? So no one's going to tell us their model isn't going to work for 2024 in the same way we wouldn't tell anyone that we're going to be bad at our jobs next year. I think that's not. Yeah. At the base level, no one's going to fully say that, right?
My base case scenario.
Right.
Yes.
But they did point to a couple key things, and these are things we've been talking about a lot in terms of the labor market coming into better balance, right? Yeah. That difference that you've seen between, say, job openings and job hires in that JOLTS report, basically unprecedented. So it makes it hard to understand and hard to predict the labor market. And they also think something like the labor force participation rate. We now are back at pre-pandemic levels in the labor force participation rate, right? So now maybe we see layoffs actually happen. And you do see that unemployment rate tick up a little bit as people have been expecting, because it seems like overall employers have the amount of workers that they wanted, right? That was a big part of the story coming out of the pandemic was employers couldn't get enough workers, Well, look at the leisure and hospitality sector now. It's a little bit back to normal. So then they feel like the forecasts will hopefully come a little bit more back to normal in 24.
We'll see. It's going to be put to the test.
Yes.
We're doing this segment a year from now. We'll see how accurate they are.
A lot of them say no recession in 24, though. So I think we're all rooting for them to maybe be right this year. We don't want a recession.
We very much are. Yes. A little bit different than how we were feeling about some of those forecasts at the start of 2023.
Absolutely.